Hey everyone, welcome to today's episode. We have a very special guest today. His name is Scott Kosch. Scott is the founder and CEO of Kosch Capital, and he is an angel investor. I don't want to steal Scott's thunder, but what I really want everyone to get out of this call is to understand the different types of investment types, and angel being one. So Scott's going to give us all sorts of great insight into angel investing and how that could potentially be a source of funding for your business. So Scott, yeah, maybe just introduce yourself and tell us a little bit about your business.
Sure. Well, first off, thanks for inviting me to do this. Always happy to talk about investing and particularly angel investing and really help entrepreneurs educate themselves as to what the process looks like. So I've been investing and advising startups for almost 20 years through Kosch Capital, which is just investing my own money as an angel investor. Over that time, I've made over 100 direct investments in companies, as well as I'm an investor as a LP, a limited partner in several early stage VC funds.
Oh, cool. Good.
Um,
And what about in the life sciences field, Scott? I know you've done some investing in life sciences, and we'll drill into that. But what do you find interesting about investing in life sciences?
Sure. So, frankly, for the early part of my journey as an angel investor, I somewhat avoided healthcare and life science sectors for a few reasons. And more recently, in the last decade, I've actually found more opportunities that I found attractive in life sciences and healthcare than I have in some other sectors. The reasons why a lot of angel investors tend to avoid these sectors. One is simply depending on where they made their money in the first place. So if they made their money in software, they tend to focus on investing in what they know. But then there are some legitimate concerns that angel investors have in these sectors, which is slower market adoption than, say, a new software technology where you can just put it out there and start getting subscriptions. Also uniquely, you've got a lot of regulatory risk depending on, what sort of FDA approval or other approvals you need to get in this sector. And, as a result, a lot of this space as an angel investor is you're concerned about the bigger fish coming along to continue funding because there's only so much funding you can provide. And so the less follow-on capital in terms of institutional capital of venture capital funds that are dedicated to healthcare and life sciences or corporate VCs in this space make it a more challenging place to invest as an angel investor.
Interesting. Tell us just a little bit more about the whole sort of funding process. You had mentioned, angel investors and then having VCs coming in different stages. Tell us a little bit about that and how that works.
Sure. So, the standard line as an entrepreneur that you hear is like you need to get a referral into an investor, and that is true, and not necessarily. It doesn't always seem to make sense why that would be important. But when you're getting a lot of deal flow as a professional investor, whether it's institutional, meaning you're spending other people's money or you're spending your own as an angel investor, there's sort of the initial screening process, and it's just a lot easier if you're getting a referral through somebody you trust. You're not relying on that referral to make the investment, but it just gives you as the entrepreneur a little bit more credibility that the investor says, should I spend time on this and dig further or not? So I think it's really important to understand the process of deal screening for an investor as an entrepreneur and think about how you can make their job easier.
So you had mentioned that you've invested in about 100. How many have you evaluated? Like, what's the investment percentage rate?
Yeah, thousands. I mean, not that I keep track, but my guess is by now I've looked at least an executive summary on probably 10,000 different companies.
So you're getting like several a week still that come across your transom?
Yes.
And again, you had mentioned referrals, but I mean, what advice would you have for a founder that maybe is seeking, an investor that doesn't have that referral source?
Right. So, a couple things. You probably do have some referral through, a lawyer, an accountant, a friend, who is in the industry that you're in, or that you're targeting in terms of your customers. The ideal referrals are actually another investor, industry experts, as well as other entrepreneurs, even if they're not in your sector at all. So, for instance, I might get a deal that's referred to me in life sciences by a entrepreneur I know in clean tech. And you go, well, what's the relevance? The only relevance is I know that clean tech entrepreneur and I trust them, and they don't want to send me a deal from someone they don't trust and believe in. So if you actually sort of cast your net broadly as to who you know, you'd be surprised who you might come up with.
So I guess then it's really important for founders to, obviously it seems obvious, but to be networking, right? But networking not only with potential customers, but also with potential investors or entrepreneurs who are in the same sort of sphere, I suppose.
That's right. And one thing that I often advise entrepreneurs, even when they're, long before that they should actually be seeking institutional venture capital, is it doesn't hurt to start talking to who you think those institutional investors are going to be for you early on in the process. In essence, they can provide two very valuable things to you. One is they're free consultants. If they'll listen to you, they can tell you where it is you need to be before they're going to be interested in investing, what milestones you need to hit. That can be really helpful in trying to figure out what you need to do over the next year or 2 years before you're actually coming to them looking for money. And two, you're just simply establishing a relationship with them, and having any relationship, which is just like having that referral source, is really important to building trust and confidence. If you can come back to them 2 years from now and say, hey, I've achieved the milestones you told me I should. Can we talk now? That's ideally exactly where you want to be at. And then last, they often know people that are investing before them, earlier in the process, that they could provide referrals to. So networking, not just amongst the sort of the angel crowd or the business crowd in general, but even trying to figure out how you can go to a venture capitalist in the space and treat it as more of an informational interview. I mean, frankly, saying, I'm not looking for money from you right now. I'm looking to build a relationship and get your advice. That does not fall on deaf ears. They want to be able to see your deal before anyone else. They want to build trust with you so that you're their first call when you're ready. So that's a really useful strategy.
Cool. Well, that's a good segue into the next question here around evaluation criteria. So obviously, I mean, you're investing in very early stage companies. So what are some of the factors that you consider when, deciding whether to make an investment or not?
Sure. So, the three standard pillars for making any early stage investment are assessing the team, the market size of the opportunity, and whatever the technology, core technology is. So, the taking those in order, the team, it's much better in general, to invest in a team that has experience in that sector, maybe has a success or failure under their belt. And to be clear, it doesn't always have to be a success. You often learn more from your failures than your successes. But having a team that has some experience is really important. Having a market size that's large enough to justify the type of investment and returns that we're talking about. Not every company should be funded by professional angels or be seeking out venture capital. In fact, the vast majority of companies shouldn't.
Right.
So, I try to, help people understand whether that's even the right path for them in the first place. And then third is, do they have some sort of proprietary technology, some competitive advantage that could have some endurance? There's nothing that's forever enduring in terms of competitive advantage. But do they have something, whether it's foundational patents or a technical lead in an area that'll be hard to duplicate, trade secrets, whatever, or are they just one of many trying to do the same thing in the same space? And then as an addendum, I would say for startups in the healthcare and life science space, a fourth factor is assessing the regulatory risk. Because that can often increase the time to market, sometimes exponentially, to get through regulatory hurdles.
Right, Scott. So you mentioned the team assessment. One of the things you see a lot of in life sciences are advisory boards. What's your take on that? I mean, are you impressed when you see an entrepreneur sort of show their advisory board? Does that count as part of the team? How sort of on board does the individual have to be on the team in order to really be considered as part of the team?
I'm a big proponent of advisory boards, and by advisory board, this is separate from the board of directors.
Yeah.
And oftentimes, particularly in life sciences and some healthcare spaces, you may have more than one advisory board. You may have a medical advisory board that's separate from a more general advisory board from a business standpoint. And I think they're just very valuable, partly in showing that some of these people have an interest in your business. They may have a stake, they may not. And so, how committed they are to it is certainly relevant. But it shows the type of people that you've been able to collect around you to provide advice.
Yeah.
And that's what you really need to be thinking about more than anything when forming these advisory boards is how can they help you, and how can they help you in terms of finding early customers, or they've been there, done that, and can provide advice on who you should hire next, what markets you should go after. In essence, they're consultants going along for the ride, and I view that as very valuable.
Yeah. So let's talk about the actual pitch itself. So what are some of what do you look for in a good pitch? What are some of the common mistakes that you see?
So one of the common pitfalls is to not think like an investor. So what I try to say is that as an entrepreneur, you are really the ultimate angel investor, because you're investing in one company. You're putting all your eggs in one basket. If you think about myself as an angel investor, investing in 100 different companies, it's a financial commitment, but it's not as big a commitment as you're making to that one business. So if you put that investor hat on, you start thinking differently. You start thinking not just about how exciting the opportunity is, but what are the risks? How do I de-risk this business over time? What are the key hurdles I need to overcome? How do I view this company? And to give sort of an analogy from life sciences, how do I treat this business as an organism? What do I need to make this thing survive and thrive? It needs money. It needs different types of funding along the path. In order to get that money, you need to reach certain milestones. You need to have a revenue model that's attractive to investors. You need to think about cash flow. You need to think about the timing and what liquidity options are available. These aren't the questions that the entrepreneur, or certainly a first-time entrepreneur, usually is focused on. They're usually focused on sort of the opportunity and how to develop the technology and where to find those first customers. And they're talking to investors about how excited they are, which is key. You have to be able to show that you have excitement and commitment, but also calling out the actual red flags or gaps that you feel you have, and saying how you're going to mitigate them. Those are the questions they're going to ask, or they're not going to ask, and they're going to assume a negative answer. If you can ask and answer it before they ask you the question, that impresses them. If you can answer the question before they don't even ask it and then assume a negative answer, you may have just avoided the reason why they move on that you're not even aware of.
Yeah. So what about due diligence, Scott? So obviously, healthcare, very scientific, oftentimes, regulatory concerns. What do you look for from a due diligence standpoint? I mean, do you do your own due diligence? Do you outsource a portion of that? Tell us a little bit about how you go about that.
Sure. So I do have to outsource in certain businesses and particularly in highly technical life science and some medical device businesses. I have to outsource some of that assessment of technical viability, regulatory risk, a complete understanding of the competition. And so do VCs that even come to the space where they're dedicated to that area because they're still looking at a new medical device in an area that they're not as familiar with. And so you've got to seek out those experts to really make that type of assessment. Where I do get more involved directly is in terms of market validation, speaking to potential customers, potential suppliers, anyone involved in that ecosystem that can, give me an opinion that might be relevant, as well as people that I can speak to really understand the team better and how that team has experience together in the past. Again, success or failure is can both be good experiences. And speaking to references beyond the references that the entrepreneur gives you is very important.
Gotcha. What about, so assuming you make an investment, how active are you in whatever advising, mentoring these teams? What would you consider maybe a best practice for a founder that whatever maybe they happen to get some funding from an angel? What's the best approach, Scott?
So, best practice as an entrepreneur is to find angel investors that can provide value beyond the money. But that doesn't mean, when you're putting together a syndicate of angel investors that, some of them can't just be money. But regardless, you are sort of entering a partnership, a marriage with these investors. And a troublesome investor can really, be a fly in the ointment, suck time away from you. And so it is important to try to get to know these investors. And the best way to understand how they treat their portfolio companies, either being helpful or just simply being out of the way, is to talk to other portfolio companies that they've invested in. And get really frank feedback about what they've been like as an investor. Have they been helpful? Where have they been helpful? How have they been unhelpful?
Yeah.
That I think is really a best practice for the entrepreneur. Now, as an angel investor, a lot of angel investors really focus, maybe even more than they should, on investing in companies where they think they can add value. And that isn't necessarily the best screening process because, again, I can add value where there's a weak team. And a weak team is not a good thing to invest in.
Right.
So, again, an angel investor who can provide some advice, be a consigliere in certain areas, whether it's helping you with sales and marketing, whether it's helping you with HR, whether it's helping you with understanding the further rounds of funding, is really helpful. But most important is they're just supportive, whether they can provide expert advice or not.
Scott, this has been a great interview so far. We'll just going to wrap up with one final set of questions, just around maybe, first of all, your thoughts on the market outlook, maybe the market outlook in general. If you think about biotech, if you think about, kind of more healthcare AI, very popular right now, very hot. And then also just, maybe wrapping up with like a few real kind of pearls of wisdom for founders.
Sure. So, one pearl of wisdom is to understand that there are going to be bad financial markets. There's going to be delays in whatever you're trying to do. You're going to hire people that aren't going to work out. Murphy's Law is real. And although you're in this business probably because you're an optimist, in reality, it's a challenging path. If entrepreneurship was easy, everyone would do it. So you have to be persistent and be aware that there are going to be challenges that you have to overcome. Currently in the market, particularly at the angel investing level, it's a rough market for investors in general. You're seeing a lot of deals get funded at ridiculous valuations with huge amounts of cash, particularly in artificial intelligence. And then you're seeing a lot of traditional sectors languish and find it very difficult to raise capital. It turns out, if you look historically, when times are tough for to be able to start a company, a lot of times that's where the best companies are born. That 7 to 10 years later, you go, why didn't I invest in that? Where the heck did that come from? Versus the periods where money is flush, and everyone is throwing money at everything in the world, and it would be easy for you to get off the ground. Oftentimes, there's very few of those companies that end up being successful. So, recognize that just because times are hard, that actually can be a great time to enter the market. And particularly because early on, you're not necessarily entering the market in terms of selling a product yet. The fact that it might be a difficult market for selling might be fine because you may be working on your platform or your technology for the next few years. And by the time you're ready to commercialize, the market's ready to accept your product and investors are ready to give you the growth capital you need. So it's really sort of a double-edged sword in terms of looking at the funding market and what's a good time to be starting.
Gotcha. So I guess at the end of the day, you have to believe in what you're doing and you have to go all in and whatever, right? If you're successful, then you're successful.
You have to. And then you have to, in addition to the things I've said before about meeting the investor where they are and thinking like the investor, you do have to make sure you're telling a very compelling and easy to understand story,
Right.
Particularly if you're in a highly technical field. They get that you're in a highly technical field. They get that you're smart and you're an expert in this field. You need to make it understandable and digestible to them. And then you need to expect a lot of rejection. When you're talking about raising an angel round, where let's say you're going to, raise money from 20 investors, you should expect to have to talk to 200 of them. And you should expect that early on, as you're getting better at that process, you're going to, go from a high rejection rate to hopefully a lower rejection rate. And the same is true with VCs. You look at these companies that you go, oh, that must have been really easy, and they have some real blue chip VC who invested in them. They probably talked to 10 VCs before they closed at least a lead investor. They probably talked to 30 before they closed the whole round, and the whole round maybe 3 investors. So you have to expect a lot of rejection. You've got to be persistent, and maintain a positive outlook in the face of a lot of rejection.
Cool. Well, Scott, this has been extraordinarily helpful. Thank you so much, and all the best of success going forward.
Thanks, Dario. Appreciate your time.